or you can use the two-step formula, which is net operating income divided by sales divided by average operating income, average operating assets, right? So in the case, in a sense, 500,000, 500,000 cancel. Answer going to be 30,000 divided by 200,000. Answer going to be 15%. The one-step formula is just giving you 15%, but two-step formula is giving you 6% multiplied by 2.5. What does it mean? It means from the sales of 500,000, you are getting 6%, 6% net operating income. So whatever you sell, 6% is your net operating income, right? And how much you are utilizing your assets to generate sales? You are selling 2.5 times of your operating assets. So this chair, this table, this laptop, the fan, the AC, the building, everything is using, we are using 2.5 times of the sales. Yeah, or to generate, say, or the sale is 2.5 times from our productive assets, operating assets, right? So this is how we can find out the efficiency of our operating assets or department, head office department, whether we have bought too much furniture, whether we have bought too much facilities for the employees, right? So that our now, because of over excessive furniture, our ROI is decreasing, or less or higher, you need to see that. Okay. Now, assume the Regal managers invest 30,000 pieces of equipment that increase sales by 35,000, but operating expenses increase by 15,000. So let's calculate the ROI. So our new profit gonna be our new investment in equipment, our new average operating assets gonna be increased by 30,000, from 200,000 to 230,000. Our income is now increased by 35,000 minus 15,000 expense. So our income is being increased by 20,000. So our total income now going to be 50,000. So you see here, if we calculate ROI, our ROI has increased from 15% to 21.8%. Look at that. ROI here was 6% multiplied by 2.5 times, right? But now, even though in total our ROI has increased, is because sales increased, but turnover has decreased. It's 2.3. Look at here, from 2.5 to 2.3. Right? Now the head office managers, would they be interested to buy this technology? No. Why? Because they will say that our performance is linked with turnover, and because of this, our turnover has decreased, so we are not buying this technology. Look at the overall ROI. Overall ROI has increased from 15 to 21.8%. So that is the biggest drawback of decentralization. Right? Because they are not thinking overall the organization. They are thinking on their department wise. Because my salary is linked with the turnover. So my turnover decreases, so I'm not going to be investing in here. Right? So now criticism on ROI is that in the absence of balanced scorecard, management may not know how to increase ROI. Managers often inherit many committed costs which have no control over them. Managers evaluate ROI, may reject profitable investment opportunities here. Profitable investment opportunities they reject because their salary is linked with the turnover, and turnover has decreased from 2.5 to 2.33. Right? So before going into learning objective 2, let's take a break and then we start again from here. Okay, class, welcome back after the break. So we completed our learning objective 1. And now our second learning objective, which is compute residual income and understand its strength and weaknesses. So up till now, what we have covered? We have covered ROI, and we saw its drawback, and we saw its the biggest drawback, that what happens if we base our performance on ROI. So managers may reject profitable opportunities because of the use of ROI, right? So we have a new method, that is residual income. So what is that? So residual income is, its definition is net operating income minus some minimum return on asset. So in order to eliminate that problem in which the managers may overlook the opportunity, profitable opportunity, because they are not interested because of ROI, their perks and benefits, their performance goes down. So they devise another performance measurement method, which is residual income. So net operating income above some minimum requirement. So its formula is net operating income minus some minimum required rate of return on average operating asset. So what is required rate of return? It is the return that you are expected to earn. You are given a task, you are given a limit that you will be earning 15%. And if you earn 20%, it means you are good. If you earn 12%, it means you are doing bad because you didn't meet the minimum requirement, right? So this computation is different from the ROI. So you see here, it is different from the ROI. So because ROI measures net operating income relative to investment in average operating income, whereas the residual income measures net operating income less some minimum required rate of return. In this case, you do not have to see that how much I am earning on the top of operating assets, in which you are given some minimum requirement. If you fulfill that one, if you are above that one, you are doing good. If you are less, then you are doing bad, right? Let's do some examples here. So we have a retail division of Zephyr Incorporation, which has average operating assets of 100,000 and is required to earn 20% on these assets. In current period, the division earned 30,000. So what is the residual income? It is current income minus return, minimum required rate of return on assets. So return on assets is going to be operating assets 100,000, 20% is required return, so 20,000. They are required to earn 20,000. Instead, they earn 30,000. So what is the residual income? It is 10,000. So you can see from this picture, they are above a minimum, residual minimum required return. So their residual income is 10,000, right? So motivation and residual income. Why we should prefer residual income over ROI? Because residual income, it encourages managers to make profitable investment that would be rejected by managers using ROI. So in previous ROI, in previous learning objective, we have seen that although our ROI have increased from 15% to 22%, But managers reject that. Why? Because its performance is linked with the asset turnover. Asset turnover decreases from 2.5 to 2.33%, right? So now we have another example. So I'm going to give you 5 minutes to solve this and find out what is the ROI. So your time starts now. So those who are watching online, please pause the video and answer this. I'm going to pause the video here, and after that I'm going to be resuming that. So here we go. So we have here ROI formula is net operating income divided by average operating assets. So we have 60,000 divided by 300,000. Answer is 20%. Answer is D. Now, Raymond Evening, a division of Wrap-Up Corporation, has net operating income of 60,000, net average operating assets 300,000. If the manager of the division is evaluated based on ROI, she wants to make an investment of 100,000. Would it generate additional net operating income of 18,000 or not? Okay, you are required to find out if the manager of the division is evaluated based on ROI, will she be able to invest in this asset to generate another income of 18,000? So, how we are going to solve it? If they invest it, their answer is their net income, their net operating income going to be 60,000 plus 18,000. Answer is 78,000. And their net average operating assets are 300,000 plus 100,000. Answer is 400,000. So if you divide 78,000 with 400,000, what is the answer? $19.5. In our previous example, ROI was 20%, and now ROI has decreased to 19.5%. So if her division is, its performance is evaluated based on ROI, so she will not make investment in this operating asset. She will reject it. Why? Because her performance will go down.